everyone, this is Mega, and today I wanted to review some relatively unbiased trading strategies that proved to be profitable in the past. For traders that look at the long-term trend, there is a fairly simple way to determine if you're in an uptrend or if you're in a downtrend. You take the 20 or 30-day moving averages and you place it over the 10-year chart. If the average is moving up after having formed a valley floor, the direction is higher. If it's moving down after having formed a mounting top, the direction is lower. Like here, mounting top, and here. You can also trade the long-term trend by watching the golden cross and the death cross. This means the crossover of the 50 and the 200-day moving average. For trading the intermediate-term trend, we could choose to watch the 50 and the 20-day moving averages. When the shorter term, which is the 20-day moving average, rises above the 50-day, it generates a buy signal. And when the 50-day moves above the 20-day, it generates a sell signal. Now, following this simple strategy would have resulted in a very healthy gain since 2007. There are a couple of drawbacks, however. One is slippage. This happens when the averages touch but do not cross. Most of the time we watch the slow stochastic so we can avoid falling prey to slippage. For instance, if the 20-day moving average touches the 50 DMA and is about to display a sell signal, but the slow stochastic is clearly in an uptrend, we treat this as non-confirmation of the sell signal, and unless the 20 DMA moves substantially lower than the 50 DMA, we do not enter a short position. Here are some examples of non-confirmation. Here, as well as here. The second drawback to this method is that in a market where prices move sideways for a prolonged period of time, such signals are unreliable. How can we know if we enter a market that's going to move sideways for a while? A pretty reliable, though lagging indicator is the breadth of the Bollinger Bands. When the Bollinger Bands converge or get closer together than normal, like in the 1994-1995 and the 2004-2006 period, the market is trading sideways, and the intermediate-term trend moving averages are not to be treated as the only good indicator for technical analysis. As you can see, though, this is currently not the case. Now, let's look at some swing trading strategies. We take the 10-day and the 20-day moving average, a shorter term now for these. And once again, when the short-term MA goes above the longer-term MA, we buy, and vice versa. In cases where the averages converge, we look to the slow stochastic for hints of whether they're going to cross, like here, or not, to see if we get confirmation. Now, for those swing traders who like to pick their intermediate-term tops and bottoms, there is a useful tool that they can use. First, determine if you're in an uptrend or if you're in a downtrend. See if the 20 MA is above the 50 MA. Do you have higher highs and higher lows? Is the 20-day moving average rising? Are you above the 200 MA? If the answers to these questions are yes, you're in an uptrend. Now, look at the RSI, which is the Relative Strength Index, and the slow stochastic. If you're in an uptrend but the slow stochastic is oversold, below this line, you're likely forming a short-term bottom, and you're likely going to get a bounce, as was the case here, 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 and here, and also here. If the RSI is overbought above this line, and the slow stochastic is also overbought, you are likely forming a top, like here. Now, it is important to use the 6-month to 1-year chart when you're using this technique, as it does scales. And lastly, for short-term traders, a useful indicator is the crossover between the 5 DMA and the price. When you're in an uptrend, you buy when the price goes above the 5 DMA and you sell when the opposite happens. You do not go short using this strategy when you know you're in an uptrend. As you can see, you catch most of the move higher, then you sell, and then you buy back at a lower price again and again and again. You do this by watching the 3-month chart. In a downtrend, you sell short when the price goes under the 5 DMA, and you cover when it crosses back. Alright everyone, this is it for today. Past performance does not guarantee future results, and you should rely on your own due diligence. Don't just take my word for anything. Next time, I'll have a video on Elliott Wave, and you should have a great trading week.